Welcome to USA Watchdog. I'm Greg Hunter. With us once again, John Williams at shadowstats.com. John Williams coming to us from California. John Williams, thanks for joining us today on USA Watchdog.
Thank you for having me, Greg.
Well, I want to start off with what you've been talking about in some of your reporting on, your letter to your subscribers, and that is the concept of the false dawn. That, what you're saying, that this 4.6% revised to second quarter is not what it really is, not the picture of what they want you to believe. It really isn't. The economy isn't getting better. Will you describe your concept of the false dawn?
Well, the term, as I most recently heard, it was courtesy of former Fed Chairman Alan Greenspan. He can be very creative with words, and I think he got this one right, although I've had many disagreements with his policies over time. What we're seeing here is a very big pitch in the political media, the financial media, that the economy has recovered, hasn't recovered. You look at the GDP, which has a lot of built-in biases in it. It actually contracted in the first quarter, and then it boomed in the second quarter. I'll contend that the aberration was the second quarter number, not the first quarter number. We're seeing all sorts of things that indicate that the economy is not recovering, never has recovered, and that it is turning down again. And as an underpinning to the stock market, as an underpinning to dollar strength, that creates all sorts of risks, including what happens with Fed policy.
Well, just to bring in a couple of charts from your one of your latest reports here, and this is the GDP. This is what they want you to think the GDP is, and it's this line, where it's up, going up, and it's just growing, and we're out of trouble, and here's this big dip down here. And when you adjust it the way you adjust it, so take a good look at that. That's what they want you to think is happening, that we are steadily growing our way out of trouble, and things are going good, and we have a new dawn, a new day of dawning. But when you take a look at your, when you readjust your chart, let me make sure I have this right. Yes, I do. When you take a look at this, you have this up, and then you have this plunge and this flat line. So the economy is just flatlining right here. Is that so? Instead of getting this, what they like you to believe is happening, what we're really getting is this plunge and this flat line, this bottom bounce is what you're talking about.
Right. We could go back to the first graph a minute.
Yep.
This is in slightly different time scales. Far left, you see a little bump, and then it falls off.
Yep.
That's the Great Recession that we just had. And then in the middle of 2009, it just starts recovering, and now we're well above where we were before the recession, if you believe the GDP numbers. The bottom lines there are the sales of the Standard & Poor's 500, the top line deflated by the GDP's implicit price deflating, the same inflation basis of GDP. That hasn't recovered. And what you'll see is most recently it's actually been trending lower. The lower lines of CPI. And the key there is how you use the inflation number. The GDP numbers are adjusted for inflation. And if you adjust by an inflation rate that is too low, the resulting implied growth is too high. And that's exactly what's happened here. They've changed the methods of calculating inflation. They're understating inflation in the GDP by at least 2 percentage points. And that's what gives you the second graph. And that second graph, you'll see the peak is pretty much over to the right. The last peak there that's the same peak that you see in the first graph. But then you have plunge and stagnation. And that plunge and stagnation is what we've been seeing on an ongoing basis since this crisis began. And the reason that it's stagnant, the reason we've not had an economic recovery, is that the consumer isn't able to fuel it. 72% of our GDP right now is the consumer, personal consumption, residential expenditures and such. It's not happening. The consumer is not liquid. The consumer has not had real growth in income. And if your income is not growing, there's no way you can sustain positive growth shy of expanding your debt. And in this debt crisis, that's not available the way it used to be.
And what do you think of this gyrations in the stock market? They're big, three-figure numbers, up 150% 150 down, 150 up, up and down, these big gyrations. What do you think that is happening now? One of the things you say in your reports is that at some point everybody's going to say, "Oh, the economy really isn't getting better. That the numbers really aren't getting better," and you're going to see everybody running for the exit doors at the stock market. Is that what part of this is right now? There's this gyrations.
Well, that is part of it. I can't give you a good reason as to why the stock market would be as high as it is. And the fact that you're seeing this volatility means that there are a lot of people who are very nervous about what's going on and where things are in the market. It's probably one of the great bubbles of all time, and it will most likely will collapse very much along the lines of the U.S. dollar here in response to the reality of no economic recovery and a number of other factors. Some years ago, in fact, in the late 80s, after the stock market crashed in 1987, I hired a mass psychologist to see if he could give me a good explanation as to why the stock market tended to crash in October and November. October crashes in 87, back in 1929, was November. And his explanation to me was that at this time of year, at least in the northern hemisphere, we have what's referred to as a vestigial squirreling instinct among people. People, where the squirrels go out and start gathering acorn to survive the winter, seasons start to shift. There's an innate shift in sentiment among people that can trigger very unusual market movements. If the market's vulnerable to it, I can't think of a more vulnerable market than we've been seeing here.
Well, you've been calling for panic dollar selling. And
yes.
What is going to kick off the panic dollar selling? One of the things that you were talking about in your latest report is that you think that the next series of reports, or the series of reports coming in between now and the end of the year, are going to show big, terrible numbers in retail sales and trade deficit numbers and employment numbers. You think once this weight of this data starts piling up, that the rest of the world will say, "Oh, America really is in trouble. Sell, sell, sell." Is that your thumbnail?
Well, that's one of the major factors. The big factor again here is as you say, is the dollar. And there are all sorts of things that impact that. The economy is probably the biggest item, but then you also have Fed policy. And right now there's a presumption that the Fed's easing is over. When is it going to raise interest rates? And guess what? If the stock market continues going as it is, the economy starts turning down sharply, the Fed's going to be back in there easing again. It'll use the weak economy as cover for its actions, trying to prop up the stock market, trying to prop up the banking system. The weak economy is not good for the banking system. The banking system's not normal yet. The Fed's primary function in life is to prop up the banking system, keep that solvent. The economy's a sideline for it because there's very little it can do, but it can use the weak economy as political cover for flooding the system with liquidity for keeping the banking system afloat. All of that, any easing action, any pullback from the tapering, any general shift in expectation that the Fed is going to have a QE4 or something like that, will tend to hit the dollar very hard. And along with that, spike gold prices, and you're off and running. So the Fed policy is a factor, the economy is a factor, political stability in the United States is a big factor. And really, I'd say the United States only because I'm looking here at the U.S. dollar. All these items are relative to the rest of the world. And what I have found over the decades is that a good surrogate for political stability is the positive rating of the president. And right now you're seeing something that keeps pushing historic lows both for the president and for Congress. That's a big negative for the dollar. So you have really a confluence of extraordinary factors that are coming here together that at some point will cause the dollar to break. We'll have a panic decline in the dollar. Along with that, I would expect you're going to see heavy dumping of U.S. Treasury bonds and stocks by foreign owners. The Fed may come in and intervene in the markets and rally the stocks. They certainly have done that in the past. Some people saying, "Oh, the Fed's got to come in and get the stocks back up so the stocks can help support the economy." Well, they might be able to rally stocks. The problem is if they're doing that, again, there's going to be a negative reaction in the dollar. And the effect is that any gain that you see in stocks is not a real gain. It's not a gain in terms of the purchasing power of the dollar. Let's say it's measured against the Swiss franc or it's measured against inflation. So it's we're coming in on the end game here. Very dangerous circumstance. High volatility in the markets. I'm still looking for a crash in the dollar, and with that, you'll tend to have crashes in the equity and bond markets domestically.
You know, you brought up in your newsletter, and it's the first time I think I've seen this, the rumor of QE4, that already talking in big financial circles of QE4. What do you, if you're an odds maker, what do you suspect the odds of QE4 in some form happening again?
Virtual certainty in the event of a stock market crash, a virtual certainty in obvious deterioration in the quality of the banking system. That's happening. And again, what has been the political cover here all along has been the weak economy. Very little the Fed can do to stimulate economic activity. Mr. Bernanke admitted that when he was Fed chairman. But being able to get the cash into the banks, cash into the system, cash into the pop up of the stock market. That's all viewed as a plus in the current circumstance. In many ways, it's probably best just to let the system find its own level, have a shakeout. You're not going to have a healthy recovery here until the system has had a chance to shake out all the waste and the fat, and people can sit back and say, okay, now we can move forward on a positive basis. That environment is not there. We've never been through that. We're still living in the shadow of the panic of 2008. I think that's the latter part of that panic is now in the stages of playing out. It's not a happy circumstance. It would have been a terrible circumstance back then. It's going to be a terrible circumstance now. They did nothing to avoid it. All they did was push it into the future.
Do you think it's worse? Do you think it's worse now than back then? You think the next crash is going to be exponentially bigger? That's what Jim Rickards says. He says, the crash is going to be exponentially bigger. What say you?
It's not. Circumstances here are going to get a lot worse, and you can't crash more than 100%. I don't think you're going to see that, but a lot of it will have to do with how quickly the dollar deteriorates and how rapidly the inflation kicks in, because that will affect how everything's being valued.
And you're still calling for hyperinflation before the end of this year? You think this could fall out of bed before the end of this year?
Well, we're looking. I've been forecasting 2014 hyperinflation for some years now, and we're coming to the end of 2014. It hasn't happened. The prerequisite at this point is a collapse in the dollar. Collapse in the dollar can happen at any time. It's the type of thing you can't really predict much in advance. It's by its nature, it's a panic and something of an irrational movement. You may be able to pick it up a couple of days in advance, but once it hits, it'll start triggering a number of factors, including the early stages of reaction from the Fed, all of which will flow into triggering that hyperinflation. So the hyperinflation can come quickly after the dollar selling panic, the big movement away from the dollar. But it's in that we're now in October. It certainly could be early 2015 before it starts taking good hold. If we had a panic in the dollar now. If I knew precisely when the dollar panic was going to be, I could give you much better guidance on the rest of it, but it will follow in fairly short order. So at this point, I'm not looking to change the outlook.
And my last question, you have a subscription service, and so you have a wide variety of spectrum of clients, everything from the small stock investor up to people that invest billions of dollars in corporations. And my last question is just simply a read of because I know you're in contact with your clients, big and small, all the time. Are your clients scared? Are they fearful?
I have had a lot of calls to that effect recently, yes. And I can tell you that in terms of big business, if you go back to that first chart that you have with the Standard & Poor's 500, that's quarterly sales of these companies in the Standard & Poor's 500. What you're seeing is that after adjustment for inflation, and that's using the government's inflation number, they're not seeing any sales growth. How can you be having no sales growth in the 80% of the capitalization of the stock market and have a booming economy? It's not happening. The best bet I can give you is the recovery is not in place. We're not seeing economic growth, and the implications can not go right down the line. They'll hit the stock market. That's one basic prop on the stocks right now. It'll hit the outlook for Fed policy. The presumption of the tapering is all based on continued improvement in the labor numbers. A lot of issues there. And in fact, you're probably going to see a pressure to move towards more easing rather than less easing. The dollar relative economic strength versus the rest of the world. The rest of the world's in recession. Guess what? We're in recession too. The whole world's in recession. We're just not showing it because we have better gimmicks in our GDP numbers. All this as a recognition of the lack of economic recovery takes hold. We have a massive shift in markets, a general outlook, collapsing the dollar, and along the lines of the general consequences that we discussed earlier.
John Williams, ShadowStats.com, the owner and founder of ShadowStats.com. John Williams, thanks for joining us today on USA Watchdog.
Greg, thank you so much for having me.